Hello friends, welcome once again to my YouTube channel. May I ask you one question? Friends, do you know that our money in the bank gets doubled in around 70 divided by R number of years, where R is the rate of interest? Well, let us see the justification for it. Okay. See here, most of the banks compute the maturity amount after compounding the interest on a quarterly basis. That is, interest is added to the principal amount after every 3 months. The formula used for computing the maturity amount is given by maturity amount MA equal to principal amount P multiplied with 1 plus rate of interest over 400 whole thing to the power 4 times the number of years for which the amount has been kept in the bank. Okay. So here MA stands for the maturity value, P is the principal amount, R is the rate of interest, N is the total number of years for which the amount has been kept in the bank. Of course, bank also calculates months and days, but let's forget that for the time being. Let us concentrate on the year-wise formula, which is this one. Now, when the maturity amount becomes twice the principal amount, then this equation becomes twice P equal to P times this. So, if you cancel P, it will give you 2 equal to 1 plus R over 400 to the power 4n. And if you take logarithm of both sides with respect to base 10, then it will left hand side will be log 2 and right hand side will be 4n into log of this quantity. Therefore, n will be equal to log 2 divided by 4 times log of 1 plus R over 400. I have prepared a table to compute this particular value and also for this particular maturity amount. So, here I have taken the rate of interest R, this is rate of interest. I show you the formula column, formula bar so that you can see what is there. So, this is rate of interest. This is the number n, number of years. So, this has been computed. You see the formula here. Okay, I can magnify it little bit. So, you see the formula here, log 2 divided by 4 times log of 1 plus rate of interest divided by 400. Okay. So, exactly this formula has been used here, this one. So, if the rate of interest I have taken from 1% to 15%, 1%, 2%, 3% up to 15% per annum, then n will be these values. And if you look at this product n into r, that is rate of interest multiplied by number of years, then look at this particular column. This is just product of these two, and it is starting with 69.4 up to at 15% it is 70.61, and all these 15 quantities has an average about 70, and you see all these numbers are round about equal to 70 only, very nearly equal to 70, and their average is also 70. Now let us compute this maturity value, maturity amount, take in n to be 70 divided by r, and let's see what is the maturity amount. So here also we have computed one table. This 70 divided by r, R is taken from this column only. So you see this is 70 divided by R, R here. R4 is this one. If you want to see the headings and grid lines, I can show you everything. Yeah. So R4 is actually this one. So 70 divided by R4 like that. 70 divided by R5. Okay. And this is maturity amount. If you see the formula, it is that formula only. V4 is the principal. See, this is V4. And then 1 plus R4 is the rate of interest divided by 400 to the power 4 into 70 divided by R, the rate of interest. Okay. So in place of N, I have taken 70 by R. Again, I use magnifier so that you can read it clearly. See, look at the formula. This is B4 into 1 plus R4 divided by 400 to the power 4 into 70 divided by R4 is rate of interest. And here if you see, I can make it little bigger so that it is perfectly visible. Now here if you see, if you take this value 70 divided by R as the number of years, and if your principal is about 1 lakh, then the maturity amount is nearly double, slightly more than double when the rate of interest is 1%. Let us look at this 5%, 6%, 7%, say 8%, which normally any bank gives for long term deposits. And here in this case, if you deposit 1 lakh, you see the amount just 503 rupees more than 2 lakh, 331 more than 2 lakh, 159 rupees more than 2 lakh, and this is just 12 rupees less than 2 lakh. So it is very nearly equal to the double of principal amount. Okay. So therefore, when your number of years is 70 divided by rate of interest, your principal gets doubled. So that's what justifies this particular statement that in our bank account bank deposits gets doubled. Bank deposit gets doubled around 70 by R years approximately. So that's all in this video. Thanks for watching.